Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome to this session. In today's lecture, we are going to talk about how central bank influence money supply through the banking system. So in the previous session, we discussed monetary policy and instruments. So at that time, we have identified several quantitative instruments such as open market operation, discount window, and reserve requirements. So at that time, we also define what's meant by money supply. So we have seen that altogether, the currency in circulation plus the deposit with the banking system is the main components of money supply. So keep that in mind. Let's proceed. How money supply are being determined by the central bank through monetary policy. So in movements in money supply, it affects the rate of interest and overall health of the economy. So the key questions that we are going to answer in this session are these. One, how is the money supply determined? And second question is, who controls the money supply? And then finally, what causes it to change? And to answer this entire money supply process, there are four players. The one is the central bank. Central bank, that is a monetary authority that oversees the banking system and is responsible for the conduct of monetary policy. So we have seen that a central bank is the apex bank, a monetary authority, and also acts as the lender of the last resort for the banking system. So for the central bank is a promoter as well as regulator of the banking system. Then comes the second key player that are called banks. Banks including commercial banks, savings and loan associations, mutual savings banks and credit unions. All these depository institutions constitute another major player in the determination of money supply process. And then comes depositors. Depositors are the general public and institutions, individuals and institutions that hold deposits in banks. So then we have borrowers. Borrowers, that is individuals and institutions that borrow from depository institutions and institutions that issue bonds that are purchased by the depository institutions. So these are the four major players. Of these, the central bank is the main, is the key player, followed by the banking system. So let's now focus more on the central bank and how central bank determine the money supply through interaction with the banking system and also with the depositors and borrowers. So as I mentioned, central bank conduct monetary policy that involves actions affecting its balance sheet. So just like any other financial institution, central bank also have a balance sheet where we can list the assets and liabilities. So let's begin with what are the liabilities of a central bank. So for the sake of discussion for the central bank, for some illustrative example, sometime I may be referring Fed. When I may refer Fed, it means the Federal Reserve System, that is the central banking system in the US, or Reserve Bank of India, that you know is about India. So let's begin with the liability side of the balance sheet of a central bank. So the Fed's monetary liabilities or RBI's monetary liabilities include currency in circulation. You know that currency in circulation, that's a promissory note issued by the RBI governor. If you go through a currency, you can see promise written by the Reserve Bank governor and his or her signature on that. So that means the currency in circulation, that is a liability for the central bank. So that means in simple terms, if there are more and more currency are in circulation, that means the central bank's liability increases. Then comes reserves. Reserves means the commercial banks and other depository institutions, their deposit with the central bank. It can include both required reserve that you already seen, required reserve for example 4.5 percentage plus excess reserve. Excess reserve means in addition to keep the required reserve of 4.5 or 4.5 percentage, commercial banks also may have some more money with the central bank, with the commercial bank's account with the central bank, that is called as excess reserve. Normally they keep it for to meet some contingency, some deposit outflow, if there is a deposit outflow or if there is any other unforeseen demand for fund arises. So in order to meet that as a cushion against unexpected deposit outflow and other monetary needs, central banks sometimes keep excess reserve also with the central bank. So as we already seen in the previous class, these are called monetary base or high powered money. So monetary base means MB means currency in circulation plus reserves with the central bank. So we have already seen one is currency in circulation and second one is reserves held by depository institutions at hand and also held in Fed account as reserve. So here liability side, what you can see that one, the liabilities currency in circulation and the second one is reserve. So you might have noticed in the beginning of this slide I told that reserve means the reserve with the central bank, that is the required reserve plus excess reserve kept with the central bank. But also here currency held by the depository institutions at hand, that also become part of reserve, because that we are not considering as part of currency in circulation, because currency in circulation means currency with the general public. The currency with the depository institutions are not part of currency in circulation. Instead, we consider it as part of reserve. So you can see on the right hand side of this T account. So T account means it's a part of balance sheet, but we only show only that key elements, key components of transaction, that one only reported, that we report in a T account. All the other things we are not touching. The complete balance sheet we are not showing here. Instead we take where the transaction take place. So we show it in a T account, not here. I will be showing you in the subsequent slides. So here currency in circulation and reserves are the liabilities for central bank. Then again, to make the idea, the concept very clear and simple, I categorized here the reserve into required reserve. That is, as I already defined, that is a portion of the total demand and time deposit that should be kept with the central bank. So that is the required reserve. And excess reserve means any additional reserves the banks choose to hold, be it with the Fed or just vault cash. Okay, so to make the concept a little bit more clear, so let us distinguish between high powered money and money supply. So money supply we have defined already. We define money supply as currency in circulation plus the demand, I mean deposits, deposit with the banking system. So that includes demand deposits and time deposit. So in short, money supply means currency in circulation plus all the deposits held by the general public with the banking system. Then monetary base, here C is common, but then R, here R comes here. So monetary base, that the high powered money means currency in circulation plus the reserve that we already defined. So you can see here that the figure I have shown here, the first part, this one is you can see that this is the money supply or money stock, that includes currency plus deposits. So in order to get this much money supply, this is the base. The monetary base is this one that you can see here, that currency in circulation, that both are same size, but reserve is you can see small amount as compared to deposit. So what you can see here is that This is the bottom part, that is the monetary base. Based on this, a central bank is able to influence the money supply. Money supply means currency in circulation and deposits. So when we estimate the money supply in an economy, we estimate what is the total currency in circulation and what are the total deposits with the banking system. So in short, Fed's control over the monetary base is the main route through which it determines the money supply. So let's now turn into Fed's, the central banks, the RBI's balance sheet. So on the asset side, it has government securities. So government security means the Fed or the RBI provides reserve to the banking system by purchasing securities from the commercial banks, from the banking system. These securities means mainly government securities that is issued by the central government and bought by the commercial banks as part of their investment portfolio. So that one, whatever is being held by the commercial bank, of this some portion will be bought by the central bank as a part of the monetary policy process that we will discuss shortly. So here, an increase in government securities held by the central bank leads to an increase in the money supply. So here, that is it's done mainly through open market operation, that the purchase and sale of government securities from the banking system. And the second asset is it can provide reserves to the banking system by making discount loans to banks. So an increase in discount loans also be the source of an increase in money supply. So the discount loans in India, there is the discount rate in India is called bank rate. Is generally because it varies during a monetary policy announcement. So in general, it's around 4%, now 4.25%, and it's actually when a commercial bank, a bank borrows money from the central bank under the discount window, it's a kind of borrowed reserve, because immediately I will be showing you shortly when a commercial bank borrows from a central bank, immediately the reserve, in the balance sheet of the commercial bank, the reserve component increases. So here, giving a loan, a discount loan to a commercial bank, that is an asset for the central bank. So you can see the central bank's assets. One is called government securities bought from commercial banks. In addition, if it lends to, for example, if a central bank directly lends to the commercial banks by buying government securities, that also become a part of asset. So this government securities, it do not necessarily mean that it is bought from commercial banks, through commercial banks. It can directly, sometimes it may lend directly to the central government and get in return, it will buy the bond from the bond issued by the government, it will buy. The central bank will buy, then the government securities will, that become a part of assets. And I have already mentioned the second component is discount loans. So let's now discuss how with some illustrative example, how open market operation it affect the balance sheet of Fed, the central bank, and commercial bank, and through which how it influences the money supply. So let's start with open market purchase from a bank. Assume that, suppose that Fed or the RBI purchases a $100 of bonds, that is government security, from a bank, and pays for them with a $100 check. So resulting changes in T account, you can see. So T account means we only show this particular transaction from the balance sheets, though because of this transaction, other components, other part of the balance sheet is not changed. So a T account we normally use only to reflect the particular transaction that we are talking. So here the particular transaction is that Fed, that the central bank, bought $100 of bonds, that the government securities, from a bank which is holding the government security, and in return this bank gets $100 of check. So let us see with the banking system, what happened that its assets decline, because initially it has been holding government bonds. Out of the total bonds, $100 of government securities, it become subtracted. It become there's a deficit of this much. So that needs to be there's a decline of $100 of bonds, government securities in the asset side of the banking system. In return, as you know that when the central bank in return, when they're buying equivalent amount $100 will be pumping to the banking system, this to this particular bank. So immediately it will become as a reserve. Maybe it has given in the form of a check. So maybe immediately say it will be ended for this bank's account with the central bank. Immediately this amount will be, that $100 will be credited as reserve. So then what about the central bank balance sheet? So there is an increase in securities because this 100 now it gets from the commercial bank, and equivalently when it credits $100 with the commercial bank's account in the form of reserve in their account, in the form of reserve, it becomes a liability here. So you can see that with the central bank there is an increase in asset, at the same time equivalent increase in liability as well. So the net result is that reserves have increased by 100. So no change in currency here. So what is monetary base? Here you can see that the monetary base has risen by 100 because monetary base means currency in circulation plus a reserve. Though currency hasn't changed, but you can see monetary base has risen, right? So reserve has risen, that means reserve is part of monetary base, and that means monetary base has risen by 100. Then suppose think about a scenario, an open market purchase from non-bank public. Assume that person or corporation sells 100 of bonds to the Fed and deposits the check in a local bank. So instead of through a bank, a person or corporation directly sells $100 of bonds to the Fed and deposit the check in a local bank. Here also the transaction with the non-bank public, securities have declined and checkable deposit has increased, because when they sell a bond worth 100, immediately the central bank will be issuing them a check, and that check, if they deposit in a commercial bank, immediately with that individual or corporation's account, it will be shown as an increase in their checkable deposits. So you can see that that is their asset. So with the banking system, because of this, the reserve has increased, because when they present this check, when an individual or corporation submit this check to their bank, then immediately with the banking system, the reserve will increase and checkable deposit also will increase. Because this reserve, you know that this money the central bank will give to the commercial bank. From there, the commercial bank will be transferring to the individual, the person or corporation who deposited this check. So the Federal Reserve System, you can see there is equivalent increase in securities and liabilities. So in summary, what you can see that the net result is that reserves have increased by 100. So but then there is no change in currency, and again you can see monetary base has risen by $100. Let's now see another case where the person selling the bond cashes the Fed check either at a local bank or at the Fed for currency immediately. So what happened that they don't keep, suppose the individual doesn't keep the money, the fund with the banking system. Instead, he or she directly cashes it. So what is the change here? The non-bank public, all these are same. Here, Federal Reserve System, here there is no banking system now. The instead Federal Reserve System, that is the central bank, RBI. So what you can see here is that RBI's securities has risen by 100. Currency in circulation, that is with the general public, increased by 100. So again here reserves are unchanged. Currency in circulation increases by 100. Now monetary base increases by the amount of 100, because we know that monetary base is equal to C plus R. Now increases mainly in terms of currency in circulation. So monetary base has risen. So this is the summary of the two illustrative case that we discuss here. So what you can say that in first case reserve has increased, That is part of monetary base. In the second case, if they cashes it out directly, there also liability, the monetary base has increased, but in the form of currency in circulation, because we already defined monetary base or high powered money equal to currency in circulation plus reserve. This is the summary of open market purchase. So we already discussed this one. I just thought of putting everything in one slide here. So similarly, this is the open market purchase. If they make open market sale instead of purchasing, sale means whatever the Reserve Bank, the central bank holds the government security, that they sell to the banking system, and then in return they take back the money from the banking system. So that normally used if the central bank want to reduce money supply or reduce reserve with the banking system. So now moving to another tool that is called discounting of loans. So key points are here is called rediscounting of bills, and then also there is direct loan to commercial banks without collaterals. So discounting of bills means a commercial bank can borrow from the central bank by selling the government securities to the central bank, but the agreement is that after certain period, maybe 15 days or 30 days, it will buy back the same government security at an agreed rate of interest, right? So in practice, the discounting of loans, these are mainly long-term loans, direct loans to commercial banks by the RBI at a discount rate. So this in India is called bank rate. In the US is called discount loan. So, but in India is called as bank rate. The non-banking financial companies, they are not allowed to use these windows, but they can participate in the open market operations with the government securities. That is, at the repo rate, they can borrow. So repo rate is mainly short-term loans. Normally, banks they borrow from the central bank to meet their reserve requirement and other very short-term financial needs, monetary needs. So making a discount loan to a bank. Here we are going to illustrate when a central bank issues a loan, gives a loan to a commercial bank, then what would happen to the banking system and the central banks as well as the central banks balance sheet or the T accounts. So here the case is, assume that Fed or RBI makes a $100 discount loan to a First National Bank, just the name of a commercial bank. So the bank is credited with $100 of reserves from the proceeds of the loan. So important thing you need to remember here that when a central bank gives loans to a commercial bank, what they do that immediately, suppose they are giving a $100 loan. So instead of directly giving the cash, central bank will credit this $100 in the account of this commercial bank that commercial bank is keeping with this commercial bank is having with the central bank. So remember that each and every commercial bank, they will have an account with the central bank. So through which when a commercial bank get a loan, so central bank will immediately credit it with that particular commercial bank's account. So what you can see here is that in this case, the monetary liabilities of the Fed have increased by 100. So you can see that because immediately the moment central bank credit, the reserve of the commercial bank increases. That means reserve for the commercial bank is an asset, but for the central bank is an asset. On the banking system, look at the banking system here, is when it gets a loan, its assets increase by $100, but at the same time, you know that when it gets a loan, that is a liability. So its liability also increased by an equivalent amount of $100. So on the Federal Reserve System, as I already mentioned, liability increased by 100. And the asset, because it has given a loan to the commercial bank, so that means loan is an asset for the central bank here. So the discount loan of $100 is an asset. So what if the commercial bank which got the loan now paying off a discount loan from the Fed? Then because it's paying off, it's repaying the loan. So what if the bank pay off the loan from the Fed and thereby reducing its borrowing from the Fed by $100. So you can see that the monetary base declined by equivalent amount. So you can see the changes in the banking system, assets of the banking system and the liabilities of the banking system declined by $100. And the federal banks is discount loans, it receives back, so that also decline, and liabilities also decline. So in this process the monetary base declines. So let's now see what are the other factors affecting the monetary base. So apart from these two, open market operation and the discount window, there are some other factors also affect the monetary base. There are mainly two important items that affect monetary base, but they are not controlled by the Fed. One is float. Float means when the Fed clears checks for banks, it often credits the amount of the check to a bank that has deposited it and increases the bank's reserve, but only later debits the bank on which the check is drawn. So this is a temporary net increase in the total amount of reserves in the banking system occurring from the Fed's check clearing process is called float. So simply float here means, suppose you got a check issued by one company or your employer, and you got $100 of, or let me just take a big amount in Indian situation. For example, 1 lakh amount of rupees of check that's issued by a company or anyone that owe you 1 lakh rupees, and you deposit this check in a bank where you hold your account. And what you need, immediately when you deposit this check in your bank, then immediately the bank will credit this 1 lakh rupees in your account, demand deposits. But at the same time, assume that this check was issued by another bank, not the bank where you are depositing this money. So immediately you can see that the deposit in your account has increased. That means reserve has increased, right? At the same time, the amount, this money was not deducted from the bank who issued this check. And all this transaction, the transaction between your bank and the bank issued the check, is not done directly. It is done through the central banking system. So when immediately this amount is credited in your account, that means it will be immediately the reserve will be increasing. Reserve with the banking system will be increasing. At the same time, it won't be deducted from the other bank. It will take some time, right? Maybe 1 hour or 2 hour or 3 hours time. Because of the electronic technological advancement, all these transactions will be settled immediately. However, there will be a temporary net increase in the total amount of reserve here, maybe for 1 hour or 2 hours. So then it causes a rise in reserves in the banking system, and thus monetary base also to rise. And second component is that when the government, central government, that is the treasury, moves its deposit from commercial banks to its account at the central bank. So when the treasury or the central government moves deposit from commercial banks to its account at the Fed, leading to a rise in treasury deposit at the Fed, it causes a deposit outflow at these banks. So it causes a fall in reserve here. You can see it causes a fall in reserves in the banking system, and thus the monetary base also fall here. So in summary here, an overview here is about the open market operation. Normally the central bank is able to control the monetary base using the open market operation, because the open market operation is done daily through the trading desk that the central bank is having, and the sale is completely controlled by the Fed by placing orders through delays. So this one is called non-borrowed reserve. And then the second one, that is the discount loan. And because you can see, first of all, about this one, through the open market operation, if they are purchasing government securities from the banking system, then the reserve with the commercial banks increases, but that is not through the borrowing by the commercial bank from the central bank, but by selling their securities to the central bank. So that is non-borrowed. So the reserve increases through non-borrowed sources. Second one is the discount loans, that is called borrowed reserve. So here, two ways it gives loan. One is at bank rate, as I already mentioned, without collateral, and these are long-term loans. And at a repo rate, I already say with collateral, that is overnight loans, and these are all very short-term loans. And here, when a commercial banks borrows from the central bank, and then immediately its reserve increases, but this reserve is borrowed reserve, because the central bank arbitrarily cannot decide. That means if they want to increase the reserve through the borrowed route, it cannot arbitrarily decide, because it depends on the willingness of the commercial banks to borrow from the Fed or the RBI. That means if a commercial bank doesn't find a more productive way to use these funds, then they won't borrow from the central bank. Or they suppose the commercial bank doesn't have any reserve shortfall, the required reserve shortfall, then it won't borrow from the central bank. So here, the second component, this borrowed reserve, is completely depends on the willingness of the commercial banks to borrow from the central bank. So in short, what you can see that the monetary base, you can elaborate it as non-borrowed reserves and borrowed reserve. What we have done in this session is that we have discussed how central bank, using the open market operations and the discount window, how they influence the money supply, primarily through affecting the reserves of the banking system. And then we made a distinction between borrowed reserve and non-borrowed reserves. Non-borrowed reserve means through open market operations, and the borrowed reserve means mainly through the discount loan window. Thank you for watching this session, and see you in the next session, and thank you.